Good morning, macro shock investors. Today, we're staring down a seismic shift that just hit the market like a wrecking ball, threatening to unravel the entire soft landing narrative. The latest jobs report is out, and it's flashing a bright, undeniable yellow light. Forget smooth sailing. The US labor market is not just cooling, it's cracking, and what happens next could define your portfolio for years to come. Are you ready for the shockwaves? All right, let's dive straight into the numbers that rocked Wall Street yesterday. On Friday, September 5th, the U.S. Bureau of Labor Statistics released the August 2025 jobs report, and the headlines were grim. The economy added a measly 22,000 non-farm jobs, dramatically missing economists' expectations of 75,000 to 80,000 additions. But it gets worse. The unemployment rate ticked up to 4.3%, marking its highest level since October 2021. This isn't just a slowdown. For the first time since December 2020, during the height of the pandemic, the U.S. economy actually lost jobs in a month, with June's initial figures revised down to a loss of 13,000 positions. Overall, revisions for May, June, and July wiped out a combined 279,000 previously reported jobs. Mainstream media is reporting this as a significant and worrying deterioration in the labor market. Publications like The Guardian, Investopedia, and CBS Money Watch are highlighting phrases like cooling labor market, slumping dangerously close to stall speed, and even a white-collar and blue-collar jobs recession. While sectors like healthcare and social assistance saw some gains, manufacturing and federal government jobs continued to decline. This dramatic slowdown, as Yahoo Finance put it, is widely attributed to ongoing economic uncertainty, the impact of the Trump administration's tariffs, and even the lingering effects of the Federal Reserve's past interest rate hikes. Now for the core of macro shock. What does this mean for your money? This jobs report has fundamentally shifted the landscape, forcing us to consider a few distinct scenarios. Scenario 1. Accelerated Fed rate cuts and soft landing, 40% probability. This scenario posits that the Federal Reserve, alarmed by the rapid deterioration in the labor market and facing increasing political pressure, will respond aggressively with deeper and more immediate rate cuts. This move would aim to stimulate demand and prevent a deeper economic contraction. The market has already started to price in such cuts, with some economists seeing this report as cementing a September rate reduction. Impact on overall market. The initial reaction could be volatile, but if the Fed acts decisively, the S&P 500 and Nasdaq could see a rebound as lower borrowing costs improve corporate earnings outlooks and make equities more attractive relative to bonds. Tech stocks in particular often benefit from lower rates. Specific market sectors. Technology could see a strong recovery. Growth stocks thrive in a low interest rate environment. Companies like Microsoft, MSFT, and NVIDIA, with their strong balance sheets and growth potential, might lead the charge as investors seek future earnings. Housing and real estate. Lower mortgage rates would be a huge boon. Home builders like D.R. Horton and real estate investment trusts, REITs, could see increased demand. Consumer discretionary, selectively. If consumer confidence doesn't completely collapse, lower interest rates could encourage spending on big-ticket items. Companies like Amazon could see a boost. Scenario 2. Mild recession and Fed overcorrection, 50% probability. This is the most probable scenario, in my view. The jobs data points to an economy already teetering on the brink. Even with Fed cuts, the lagged effects of prior tightening, coupled with ongoing trade tensions and broader uncertainty, could lead to a period of negative GDP growth. The Fed might cut rates, but not quickly or deeply enough to prevent a contraction. Economists are already sounding the alarm about recession risk. Impact on overall market. The S&P 500 and Nasdaq would likely experience a continued downturn, possibly entering bear market territory, a 20% drop from highs. Earnings estimates would be revised down across the board, and market sentiment would remain negative until clear signs of stabilization emerge. Specific market sectors. Cyclicals, industrials, materials, consumer discretionary. These sectors are highly sensitive to economic cycles. Companies like Caterpillar, CAT, often seen as a bellwether for global growth, or discretionary retailers like Target, TGT, could face significant headwinds as consumer and business spending pulls back. Financials. Banks like JP Morgan Chase, JPM, could suffer from reduced lending activity, higher loan defaults, and a flattening yield curve. Energy. Demand destruction from a recession would likely hit oil prices, impacting companies like ExxonMobil, XOM. Scenario 3. Hard landing and stagflationary pressures, 10% probability. This is the darkest timeline. If the labor market truly collapses, leading to widespread job losses, but inflation, exacerbated by tariffs, remains stubbornly high, we could enter a period of stagflation, high inflation, and high unemployment, with stagnant growth. The Fed would be in an impossible position, caught between fighting inflation and unemployment. Impact on overall market. A severe bear market across all indices. The S&P 500 and Nasdaq would see significant, sustained declines, potentially mirroring the dot-com bust or the 2008 financial crisis in severity. Investor confidence would evaporate. Specific market sectors. Almost all sectors would be negatively impacted. Consumer staples and utilities. These defensive sectors might offer some relative safety, as people still need food, household goods, and power. Companies like Procter Gamble, PG, or Duke Energy might outperform the broader market but would still likely see declines. Technology, selectively. Even strong tech names could be hit hard, especially those dependent on advertising or discretionary business spending. So, what's Dave doing with this grim outlook? Given the 50% probability of a mild recession, I'm maintaining a defensive posture, but with an eye toward tactical opportunities. I am holding my core defensive positions, think high-quality, dividend-paying companies in resilient sectors. However, I am watching for signs of capitulation in the broader market, particularly if Scenario 2 begins to unfold more aggressively. I am not aggressively buying into this uncertainty. My focus is on capital preservation and being ready to deploy cash when the dust settles or if the Fed signals a truly aggressive pivot that could lead to Scenario 1. Now, let's look at the charts, specifically the SPY, the S&P 500 ETF. The technical analysis tells us that as long as the daily chart holds above support at 640 and 620, the SPY should grind up to 665. What does this mean in plain English? Those 640 and 620 levels are critical battlegrounds for the bulls. If we see the SPY drop below 640 and then decisively break 620, that's a serious warning sign that the current upward grind is over, and we could be heading much lower, confirming a more severe market reaction to this jobs data. But if those levels hold, there's still a chance for a move towards 665, perhaps fueled by the market anticipating those aggressive Fed cuts. I'm watching these levels like a hawk to inform my next moves. What's your take on this latest jobs shock? Are you bullish, bearish, or somewhere in between? Let know your thoughts and your strategies in the comments below. And if you found this analysis valuable, please hit that like button, share this video, and make sure you subscribe to Microsoft so you don't miss our next deep dive. Remember, this is not financial advice, just my analysis and perspective as Dave from Microsoft. Investing involves risk, and you could lose money. Always do your own thorough research and consult with a qualified financial advisor before making any investment decisions. Stay sharp out there, investors.